Hello, everyone. It's me, Alan Cunningham, Editor and Chief Executive of Africa Capital Digest and the Meridian Africa Digital Dialogue Series. As we learned in earlier episodes of our series, infrastructure was one of the asset classes that posted the biggest jump in 2025. Those are numbers courtesy of ADCA. So we're delighted today to have one of the leading investors in the infrastructure investment space, Lisa Pinsley from African Infrastructure Investment Managers, who I refer to thereafter as AIIM, who joined them at the beginning of about 18 months ago now. That's right, isn't it, Lisa?
That's right. It is, Alan.
To head up their new Africa Transition Acceleration Fund, which is a planned $200 to $250 million fund focused on the clean energy and renewable energy space. And we'll get to talk about that a bit later. Um, Prior to joining AIIM, she was active for about 8 or 9 years, and before that at American Capital. So she's had a lot of experience investing in infrastructure, energy infrastructure in particular in Africa. So we're delighted. Welcome.
Thank you, Alan. Thanks for the opportunity to be on the discussion.
It's great to have you. So we're going to kick off, as I said, with a big picture, and just sort of before we drill down into the clean energy space, which I know is your particular focus at the moment. Um, Where's the capital flowing? We obviously heard that in last year it was one of the most buoyant asset classes. Where is it flowing now? What do you see happening in the sectors that are benefiting from infrastructure investment?
Yeah, thanks, Alan. And I'd say more of the same. So
Okay.
whether it's energy transition, digital, ports and logistics, I think all of those are very hot sectors, all in need of investment, all providing opportunities. So I joined AIM, which is Africa's largest infra GP, as you said, about a year and a half ago, to lead a third set of funds for them, the African Transition Acceleration Fund, which is mainly energy transition focused. But AIM itself has about $4 billion under management across three funds. And there are two
Mm,
flagship funds to date. Ideas Fund, which is a Southern African permanent capital vehicle, mainly South African pension fund investors, and the AIF set of funds, so AIIF, African Infrastructure Investment Funds. Its latest vintage, A4, $750 million. Both of those target all of those infrastructure sectors that you mentioned. So energy transition, ports and logistics and transport, as well as digital. And traditionally, the opportunities have been greater in the energy transition space with the growth of
mhm,
renewables across the continent, especially in South Africa, but across the continent. And then the private sector investment in ports, logistics, and in digital has grown considerably over the past few years. So all of those trends are ones that we are following. And in general, it's not a question of limited capital, but rather the question of investable deals. And that's the exciting space we're seeing now across all of those sectors, is that they're all increasing and the opportunities are increasing. So it's a big focus for the group.
great. Okay. Interesting. Good to hear that, as you said, there are more bankable assets appearing on the horizon. All right. Well, let's drill down into the clean energy space because obviously that's one of the major sectors. And I think in our research, the Climate Policy Initiative is a couple of years ago said that Africa needs roughly 133 billion a year in clean energy investment if it's going to meet its 2030 goals. Um, how do you read that? I mean, how's the progress towards that goal of adding 300 gigawatts by 2030 going?
Slow and steady. I think you could say a lot more additional capital is needed to get there. But I
Hmm.
think again, it's not a lack of capital. It comes back to the having not just the deals, but what's behind the bankable deals spectrum, and that's mainly policy and regulatory reform. That's the number one, and then second would be the grid capacity. So I might be answering a few questions in one here, but um, you really see the acceleration of um, generation capacity and specifically renewables, not by the availability of capital, but when the policy changes occur to allow more private sector investment in generation specifically. The big one being market liberalization. So that's, traditionally around Africa, you have the vertically integrated utilities. They have generation, distribution, and transmission. And then, they started to let private sector investment first into the generation side, but you had to contract on these long-term offtake agreements with the government-owned utility. So you were doing these very highly structured project finance deals backed by the sovereign. And so very few would happen, or it'd take a long time. South Africa had a relatively predictable renewables procurement, but again, you had to wait 3 or 4 years in between each cycle. It could have gone much faster. But once you
Mm.
see the markets liberalize and they allow private generators to sell to private off-takers and wheel that power through the grid, it explodes. So you've seen that in South Africa with the generation capacity being sold to private off-takers. I think it's fair to say has doubled the renewable generation capacity in the country in something like 4 or 5 years. I don't have the exact figures, but it's
Right.
it's
It
incredible
was
how
big.
quickly that's grown. Yeah, and we've been investing along that theme at AIIM through NOAA, through Anthem. These are all generation platforms, some that participate in the government tenders and some that don't. And then others have as well, other investors, and those platforms have gotten very big. You see that now. We see the next market that's enjoying that liberalized policy is Southern Africa Power Pool. So
Mm.
the grid is connected and the policies in place to support cross-border trade and an open market across Zambia, Namibia, Botswana, Zimbabwe, and some connectedness to South Africa as well. And that's where we see the next kind of phase of accelerated development there too. Now, if you flip up and you go up into North Africa, there's been a huge amount of
Right. I was going to
generation
ask you.
built there. Yeah, that has still primarily been driven by government utility offtake. There is policy and regulation in place to support the C&I sector there, and there are some structural reasons that it hasn't taken off to the same extent as it has in South Africa. So, for example, in Egypt, there's still subsidies for some industrial and commercial consumers that make it really not attractive to buy from anyone else but the utility because of those subsidies. And in Morocco, there are also some regulatory impediments, even if the legal framework is in place to allow it to happen. But at least you see government-owned utilities that have gone very far and aggressive in building new generation, which is also fantastic. So that's, to me, getting to those targets from your original question is less a question of capital availability, but more on the policy side. And then what you're finding on the second point is, okay, fine, if you do open up those lines and create those more free markets, then the problem is you run into congested transmission capacity very quickly. Traditionally,
Mm-hmm.
where it's very windy and sunny, have not always been demand centers for power. So you don't have big transmission lines that are built into those places. And generally, transmission lines are built by government-owned utilities over very long time frames. So that's become the second bottleneck. Some of that is being addressed through potential private sector investment in transmission to try and speed that up. Still, I mean, the projects take a long time from an environmental and technical perspective, but oftentimes the government financing is a major hurdle as well. So you have South Africa that's launched the ITP program. Again, it's not moving yet at the speed of light, but it will get there. Um, and in other countries, you do see some of the first private transmission projects coming to market. So GridWorks had one in Uganda. You see Africa 50 doing one in Kenya. The more that can happen as well, the more those barriers will come down and you'll start to reach the targets.
Interesting. So, and what's the study play in West Africa in terms of policy change, etc.? Is that tracking with the rest of the continent, or?
It depends country by country. So there is a West Africa power pool, there is an East Africa power pool that doesn't have all the countries in as good a regulatory and policy perspective as the Southern Africa power pool yet. But hopefully, the success of the Southern Africa power pool, you could see more movement in those two regions because you need both the policy framework across the whole pool, and then the individual countries as well. So, for example, you might have the ability to sell and export power through the power pool, but in that individual country, you don't have the regulation saying, okay, here are the wheeling charges, here are the export charges for you to get your power from your site to the border. And if you don't have that, then it's an individual negotiation with the utility to go get it done. So it's not like you can replicate that and do 10 of those projects in 1 year.
Right.
One
Right.
might get through. So we're certainly tracking it and hoping that the East and West Africa power pools get there. And then it comes down to individually within the countries. Most places now you can do behind the meter. So, if an industrial company needs on-site power and they have the land and they can do a 3 megawatt next to their manufacturing facility or mining or whatever, you can do that. And there are a lot of companies with those business models of pursuing behind the meter type installations. I think it's, in our experience, the bigger, the better, because if you have 200 sites that are all very small, it takes quite a lot of people to manage those for the revenue that you're receiving. So generally, we're looking at on the larger side of those behind the meter plays.
Right.
But I'd see generally in West Africa, it's more behind the meter play right now, just because of that policy framework. Again, it might differ slightly country by country, but it doesn't have that regional interconnectedness from that regulatory perspective that the
Mhm.
Southern Africa Power Pool does. Like the lines are
Okay.
there, but
Right. That's a
you can't
start.
contract. Yeah.
Right. Right.
Yeah.
Right. Okay, let's drill down into the Africa Transition Acceleration Fund. So, as an acronym, do you refer to it internally as ATAF or do you ATAF?
ATAF. ATAF.
ATAF, all right. Good. My English
Yeah.
accent, ATAF, ATAF.
That's
Okay,
okay.
let's talk about the ATAF fund. I'm right in believing it really focuses on early stage deals, correct?
That's right. Yeah. So
No,
we,
will do. It hasn't done them yet, but yeah.
and we hope to have one to announce this year, but I can't say anything about it yet. But it probably will be in that Southern Africa Power Pool market that I've been talking about. But when I was at Actis, we would back power companies or power platforms, and AIM has done the same thing, the similar strategy. Of backing a platform with a great management team and a portfolio of projects in various stages, development, construction, operations, rather than just investing at the asset level. And so you're building a growth engine rather than one asset, which really in the
Hmm.
end is provides yield, but that's about it.
Right.
So uh, what we found at Actis and what AIM is finding in their two flagship funds is, the bigger your fund, you need to look for tickets that are larger in size. And so you need to be looking at acquiring a company that has a few assets and wants to grow so that you can start with a 50 million, 75, $100 million check and then put another
Hmm.
100 million in as it grows. Um, it's hard if you're starting from scratch and you're putting in 2 million, 4 million, 10 million within the life of a private equity fund. You need to invest and exit within and grow and exit within 5 to 7 years. So investing in that later development cycle. So when you've got some projects operating and a growth pipeline, a larger ticket, there's this lack of capital for earlier stage platforms and smaller tickets. And that's the gap that ATAF is trying to address. Back to sort of my earlier point of it's not really a lack of capital in the African infrastructure sector. It's that lack of investable opportunities. And so some people, when they look at the problem, say, okay, we need more grant funding for development costs. That helps too, but that's usually on a project basis, and it's to provide third-party costs to pay your technical, environmental, and legal advisors. It doesn't really build a company. That actually
Right.
takes overheads, working capital, and your development costs. And then usually a grant would you be working on one project, whereas if you back a platform company, you could look at a portfolio of projects at the same time. One might move forward over another for various reasons. So that's the gap that we were trying to address. And that, okay, let's nurture in a very active shareholder kind of way more of these younger companies, whether they're in we've had the clean electrons, clean molecules, and sustainable transport verticals. And so that by the time, our 5 to 7 years are up, we've been able to invest from about 10 to $45 million in, with flexible capital. So that can help, you know, pay their salaries. It can help
Mhm.
put the construction equity into their projects. A lot of young developers have to sell their first project because they don't have the equity to put into their first project. So they become a sort of develop and flip model, which isn't very successful generally. Um, Usually they become one hit wonders. By the time they get their first one done, it's 15 years down the road and they're tired.
Right,
so
right.
um, so we invest in that way, and it's not totally from scratch, like a guy in a dream and a piece of paper. We like to see
Mhm.
these teams with experience in the sector or related sectors, experience in the market. So not somebody who just has a dream of building something in Zambia and has never been there, but said, "Oh, I did a power project in Eastern Europe. I could do one in Africa." So very local market experience, and has made some traction on what they're working on, whether it's a project in mid-stage development, whether it's a pilot of their EV business. You know, Again, we're not that first sort of friends and family angel funding, but we're the big scale up capital that's also flexible so that they can hire a few more people so that they can actually hire the proper environmental technical advisory and team in their own team, and hire a financial modeler, and build out that portfolio. So that's how we're doing it. And so we'd start small. We would love to put in $45 million, but it's not all up front. You start with pay and development costs and overheads. You get that first project to close or that big scale up if it's an EV company, and you put in that capex as well. And then by the end of that investment period, hopefully it's grown, you would be able to invest the money, and then we would look to sell that company to a larger financial investor, a strategic who want to take it to the next level, so that we're building things that we know as bigger investors, or when I was at Actis, or there are lots of others in that kind of sphere, what they're looking to buy. And so we're just trying to
Right.
nurture and grow in that investable set.
Okay, so you obviously mentioned the three sort of core focuses of ATAF, which is the clean electrons, clean molecules, and EV. Which do you think has got the most sustainable pipeline, or are you seeing more opportunity, and are they sort of equal?
I would say that we expect the majority of deals to be clean electrons, and that really matches the size of the markets, and how they're evolving. So EV is new. Even when we were looking for a senior advisor for the fund on EV, it's not like you've got somebody who's been doing it for 20 years.
Right. Yes,
So
they won't invent it, right?
it's new in the business models. They may have been tested other places, whether Europe or India or Southeast Asia, but they're still evolving. And then there's an Africa specific context. So because of that, and it's a newer market, then we do expect the sort of more established clean electron space, which we define as on-grid renewables, behind-the-meter renewables, battery storage, energy efficiency, transmission, and green power to X, will likely have the majority of our investments. But we don't want it to be a renewables only fund, because we see other opportunities in the energy transition infrastructure space, like in EV, like in clean molecules, that we think also see this gap in funding. So, so that's how I see it playing out, and that's reflected in the pipeline as well.
Okay. So obviously, early stage means higher risk. How do you go about? I mean, obviously, the management teams and their track record is one thing, but how do you go about evaluating and underwriting risk in the deals that you will do?
Yeah, so it's a good question, and this is infrastructure, so it's not, in some ways, when some people hear early stage, they think venture capital, and so
Right.
I'm no venture expert, but from what I understand, you do 20 deals, and most of them go to zero, and a few of them are 100x, and everybody's happy. In
Right.
infrastructure, you rarely go to 0x. It's sort of more. plus or minus around a high teens return, or something of that effect. So um, we do target infrastructure style returns, and we look for those early development dollars. First of all, our ticket sizes go up to 45 million, but we're not looking to put 45 million into early stage development risk. So we would put
Right.
sort of a certain amount at risk until the first value event, whether that is a financial close of a power project or a biofuels project. And those projects are based on long-term offtake agreements with creditworthy counterparties. So at that point, at financial close, you're unlikely to lose your money. So there's still a limit to how much development money you're putting at risk. Um, and uh, so that sort of blended return between those first development dollars, which you do expect, say, at financial close to be rewarded sufficiently, plus the construction equity, which would kind of come at a different return, and continuing on for the growth would roughly come out at infrastructure style returns, like, 2 times money and 20% are kind of the classic headline infrastructure returns. So we do expect to get there, but it's not because all of our money is allocated to high risk early stage money. We take a very kind of risk mitigated approach um, to do that, and that's why, for example, we're not there's usually friends and family or angel or something that gets a company going, pilot funding. Maybe it comes from a DFI or somebody else in market. We're at scale up capital.
All right. Well, I mean, I was a little bit down the track, but looking at the exit routes for any of the assets that you have built, what are the specific milestones? You mentioned the rate of return just out now, but what other specific milestones uh, would you need to see before you start to think about moving it on?
Growth, money invested in projects or capex, or if they're really not making progress, then you cut and run. But that's why it's key that they get to a certain scale up milestone pretty early on, because then you have to make some hard decisions. You can't tread
Right.
water for 10 years and hope that something hits.
Right.
So I think being reasonable and having been in market now about 20 years, you always have to be a bit of an optimist, but you have to be a realist about what's really going to be executed and when.
Right. Right.
So ideally, then, say it's a power company, more of a traditional power company selling C&I into a power pool, to off takers, and get, depending on the size of the projects, the solar, the BESS, get 2 or 3 projects over the line with a pipeline of other things coming. And that, you have to look at what people want to buy. And that starts to be attractive, and a um, uh, ticket size and kind of development stage for the larger financial buyers or strategics. And one of the things they look at is, okay, if I come in, I already got 2 or 3 projects spitting off dividends, which pay for the overheads. So I'm not going to have to draw down money from my fund or from HQ to pay the salaries of these people, because that's
Right.
sort of seen as sort of dead money, if you will. Not dead money, but it's not yielding money
Right.
with a
Exactly. Yeah.
20-year offtake agreement. So if you've grown enough so that it takes away that risk, then it opens up a whole basket of buyers for that platform. And then the downside case for us is if you don't, for some reason, you haven't hit gold on your management team and they're not spinning off pipeline and growing, growing, growing. Well, the downside is you sell the assets.
Right. Right. Okay, so you mentioned at the beginning of this conversation that you expect to announce your first deal towards the end of this year or by the end of this year, or you're
I hope
hoping
so.
to. Is there anything that would likely make you increase the rate that you deploy capital, like a policy change or anything in the market that would, push you in that direction?
It is, and on the power side for sure, it's that market liberalization. So just allowing more private generators to sell to private off-takers, and private investments in transmission to increase the size of the market. That would be the biggest 2 things. I think on the EV side as well, I think the exciting thing about EV is that the commercial case already exists. It doesn't need subsidies in order to make total cost of ownership for an EV, whether it's a two-wheeler or up to a certain size of truck, makes sense.
Mm.
Oftentimes the capex is higher upfront for an EV, but then the total cost of ownership, even over 5 to 7 years, is better. And plus, of course, you've got the security of supply without having to rely on the imported liquid fuels. So that said, the more that government can get behind an EV program to accelerate rollout and make it even more of a no-brainer, that'll help too.
Mm.
And you see that in Kenya, for example. So in Kenya, that there are favorable policies on import of vehicles as long as you assemble them in Kenya. There's an EV charging tariff that's quite attractive overnight because Kenya has a lot of baseload geothermal. At night,
Mhm.
they don't have a lot of demand. So it's a win-win. They can sell power
Right.
and EVs can charge cheaply. So that's helped the sector explode in Kenya. Now you have to run your sensitivities. If those are taken away, does it still make sense? Yes, it does at a certain price of diesel. But if other countries start doing that, that'd be super helpful too.
Great. Okay. Well, I think that's wrap. Thank you very much for joining us today. That was a very interesting dive into the sector and also learning a little bit more about ATEF. We look forward to hearing about that first deal when it comes off and all the future ones. Well,
Thank you.
typically, what sort of size portfolio, I'm just a throwing question, do you think you're going to have by the end of it? Are you looking like 10, 10 to 12 assets, do you think, eventually?
I think so. Um, one is always, the fewer number of deals and the larger investments per deal is easier
Hmm.
to manage.
Right.
But certain sectors trend towards different ticket sizes, right? So a power company can easily spend up to our $45 million, for example, but an EV company probably won't need that much money. That's probably more of a
Right.
$20 million ticket. So it
Right.
depends. I think it's 8 to 12 deals would
Right.
would
Great.
feel
All
right.
right.
Yeah.
All right. Well, thanks once again. It's been
Thanks for the
great talking to
opportunity.
you. Thank
Thanks
you.
so much. Take care, Alan.
Yeah. I'm just sorry, just stopping recording. Yes, I do want to stop it.